In this lecture, we will discuss variable costing. Two alternative systems are used to produce financial statements. One system is called absorption costing. You already know absorption costing. It is what you have been taught in all of our previous lectures and all of your non-cost accounting classes. The second system is called variable costing, which is what we are going to discuss in this lecture. The income statements produced by these two systems have different formats. Absorption costing uses the multi-step income statement that you have used before. It starts with sales revenue, from which you deduct your firm's cost of goods sold. This produces your firm's gross margin, which is also called the gross profit. You then deduct your firm's selling, general and administrative expenses. This leaves you with your firm's operating profits. You have seen variable costing income statements used in some of our other lectures, but you have not seen it in non-costing accounting classes. With variable costing, you also start with your firm's sales revenue. You then deduct all of your firm's variable costs. This leaves you with your firm's contribution margin. You then deduct all of your firm's fixed costs. This leaves you with your firm's operating profits. As mentioned previously, everything we have discussed so far follows absorption costing. With absorption costing, the cost to produce a unit includes all of your factory's costs. As far as we are concerned, with absorption costing, nothing in the factory is immediately expensed. Factory costs become the cost of your inventory, and they are expensed as cost of goods sold only when the units are sold. Under absorption costing, the cost to produce a unit consists of direct labor, direct materials, fixed factory overhead and variable factory overhead. GAAP requires the use of absorption costing when preparing financial statements. Variable costing is an alternative to using absorption costing to produce financial statements. It is not GAAP, and therefore can only be used for internal purposes. As we have seen, with variable costing, your income statement will separate your firm's variable costs from its fixed costs. When preparing a variable costing income statement, you are going to have a problem with cost of goods sold because it has both fixed and variable elements. For this reason, variable costing treats the cost of inventory as including only direct labor, direct materials and variable overhead. These are variable costs, and including only these costs in computing the cost of inventory makes cost of goods sold a purely variable cost. With variable costing, fixed factory overhead is no longer a cost of the inventory produced by the factory. Under absorption costing, the fixed overhead was part of the cost of a unit. This is referred to as being a product cost, which is expensed when the inventory is sold. With variable costing, however, fixed factory overhead is no longer a product cost. Instead, fixed factory overhead is treated as a period expense, which means that it is expensed in the period in which it is incurred regardless of whether or not the inventory is sold. Let's do an example. Assume that a firm produces and sells 10,000 units. The firm sells each unit for $25. The firm spent $50,000 on direct materials, $30,000 on direct labor, $20,000 on variable overhead, and $50,000 on fixed overhead. The firm's variable selling, general and administrative expenses were $3 for every unit sold. The firm's fixed selling, general and administrative expenses were $30,000. When you are doing a variable costing or absorption costing question, the first thing that you should do is to figure out the cost to make one unit. You should always do this. In our example, you would calculate the cost of one unit under the absorption costing method as follows. First, you would add up all of your factory costs. This gives you a total of $150,000 to produce 10,000 units. When you divide $150,000 by 10,000 units, you see that it costs your firm $15 to produce one unit under the absorption costing method. In our example, you would calculate the cost of one unit under the absorption costing method as follows. First, you would add up all of your factory costs. This gives you a total of $150,000 to produce 10,000 units. When you divide $150,000 by 10,000 units, you see that it costs your firm $15 to produce one unit under the absorption costing method. With absorption costing, the cost to produce one unit is $15, and it is $10 under variable costing. The $5 difference in the cost of one unit under both methods is equal to the fixed overhead for one unit. Your firm's absorption costing income statement starts with the sales revenue, which is calculated by multiplying the price of one unit by the number of units sold. This gives you $250,000. You then subtract the cost of goods sold, which is the cost of one unit times the units sold. Keep in mind that the cost of one unit is $15 under absorption costing. Also remember that the $15 cost of one unit is made up of $10 of variable costs and $5 of fixed costs. Once you subtract the cost of goods sold, you get the gross margin or gross profit of $100,000. You then subtract the selling, general and administrative expenses, which are made up of $30,000 of fixed overhead and $30,000 of variable overhead. This gives your firm an operating profit of $40,000. Your firm's variable costing income statement starts with the sales revenue of $250,000. You then subtract all of the firm's variable costs. In this example, our firm has two variable costs. It has variable cost of goods sold, which is the variable cost of one unit times the units sold. Keep in mind that the variable cost of one unit is $10. You also subtract $30,000 of variable selling, general and administrative expenses. Once you subtract the variable costs, you get the contribution margin of $120,000. You then subtract the firm's fixed costs, which are made up of the fixed factory overhead of $50,000 and fixed selling, general and administrative expenses of $30,000. This gives your firm an operating profit of $40,000. Notice that the operating profits for both methods was the same. This is the case when your firm produces and sells the same number of units. The operating profits reported under the two methods will be different if the number of units that your firm sells is different than the number of units that your firm produced. In order to show this, we will do the same example, but this time we will assume that the firm manufactured 10,000 units but only sold 5,000 units. With absorption costing, the sales revenue is now only $125,000 because only 5,000 units have been sold, and the cost of goods sold is only $75,000. Keep in mind that the cost of one unit is $15 under absorption costing, which is made up of $10 of variable costs and $5 of fixed costs. When you subtract the cost of goods sold, you see that your firm now has a gross margin of $50,000. You now subtract $45,000 of selling, general and administrative expenses, which is made up of $30,000 of fixed selling, general and administrative expenses and $15,000 of variable selling, general and administrative expenses. This gives your firm operating profits of $5,000. With variable costing, you start with the sales revenue of $125,000 and then subtract all of the firm's variable costs. The variable cost of goods sold is $50,000 and the variable selling, general and administrative expenses are $15,000. After subtracting the variable costs, the firm has a contribution margin of $60,000. You then subtract the firm's fixed costs. The firm's fixed overhead for the period is $50,000. You also subtract the firm's fixed selling, general and administrative costs of $30,000, which leaves us an operating loss of $20,000. Please note that the operating loss under variable costing is $25,000 lower than the $5,000 operating profits reported using absorption costing. We will now discuss why the two methods give you different operating profits when the units that your firm produces is not equal to the number of units that it sells. The sales revenue for both methods is $125,000. The variable cost of goods sold is $10 times 5,000 units under both methods. The variable selling general and administrative expenses are $3 times 5,000 units under both methods. The fixed selling general and administrative expenses are $30,000 under both methods. The only difference between the two methods is the fixed overhead. With variable costing, the fixed overhead is $5 times 10,000 units, and with absorption costing, the fixed overhead is $5 times 5,000 units. Therefore, with variable costing, $50,000 of fixed overhead is expensed, and with absorption costing, $25,000 of fixed overhead is expensed. This explains the $25,000 difference reported as operating profits under the two methods. The $5 per unit cost of fixed overhead is expensed is highlighted in yellow on this slide. The difference in the operating profits reported using the two methods is due to the different ways that the methods treat fixed overhead. With variable costing, the full amount of the fixed overhead for the period was expensed despite the fact that the firm only sold half of the 10,000 units that it produced. With absorption costing, however, the fixed overhead is treated as a part of the cost of the units the firm produces, and it is expensed as part of the cost of goods sold only when the units are sold. In our example, only half of the units produced were sold, and therefore only half of the fixed overhead was expensed in this period. Please note that the full amount of the fixed overhead of $50,000 was expensed using variable costing, but only half of the fixed overhead, which is $25,000, was expensed under absorption costing. As noted earlier, the difference between the operating profits reported under the two methods is $25,000, which is due to the different treatment of the fixed overhead for the unsold units given by the two methods. Because of this, you always know that the difference in the operating profits reported by the two methods is equal to the fixed overhead per unit times the number of unsold units. In our example, the fixed overhead per unit is $5, and the number of the unsold units is equal to 5,000. Therefore, the difference in the operating profits reported under each method is equal to $25,000. In our example under absorption costing, the cost of one unit was $15, and the cost of the 5,000 unsold units is $75,000. With variable costing, the cost of one unit is $10, and the cost of the 5,000 unsold units is $50,000. As you can see, the difference between the cost of the unsold inventory under the two methods is also $25,000. This is not a coincidence. The $25,000 of fixed overhead that was not expensed under absorption costing was added to the cost of the inventory of the unsold units. It didn't disappear. In our example under absorption costing, the cost of one unit was $15, and the cost of the 5,000 unsold units is $75,000. With variable costing, the cost of one unit is $10, and the cost of the 5,000 unsold units is $50,000. As you can see, the difference between the cost of the unsold inventory under the two methods is also $25,000. This is not a coincidence. The $25,000 of fixed overhead that was not expensed under absorption costing was added to the cost of the inventory of the unsold units. It didn't disappear. The end.